Okay, good evening. So I think we were discussing taxing part, that is part of fiscal policy. No. We'll discuss afterwards. Okay, class के बाद. I'm coming to that. So don't worry, we'll discuss. Backstage में रखना है. Okay, so one is, what was the last thing I made you write? So I was explaining IGST, how IGST will be levied, isn't it? That was what we were discussing. Okay, so listen. So our intention was not to discuss GST. What I was discussing is cascading effect, and after GST, how cascading effect was removed, isn't it? Okay, one was tax rate, increasing tax rate. You can increase taxes by increasing tax rate. You can increase taxes by widening the tax base. This is one thing. Third important thing, we can increase the tax by through tax efficiency. Okay, one way of tax efficiency is reducing the cascading effect. And then I would have taken a mobile phone example, mobile phone which is costing 20,000, and how it was taxed before GST and how it is taxed after launching GST. Okay, and there I would have mentioned something like GST is levied on the common base. GST is levied on common base, and that is how that cascading effect of the mobile phone 200 rupees was eliminated. Is that okay? That is clear. Okay. Then interstate trade. Whenever there is interstate trade, the article that was dealing with interstate is Article 269, isn't it? And Article 269 clearly talks about, an aspect clearly says, whenever there is interstate trade or whenever there is interstate consignment movement. So who has the levy powers? The levy powers are with the center. This should be clear. The levy powers will be with the center. Okay, the center is going to levy the tax. Okay, and though the center is levying the tax that is collected is going to the exporter state. It was going to the exporter state, or it is something like the origin state. Origin is something from where the product has originated. Product has been produced. Then I would have given you the example. I said Maharashtra on one side and Arunachal Pradesh on the other side. Okay, and let's say a car is moving, that is, you're selling a car. It can be sales of cars or it can be movement of consignment. I've explained what is a consignment. Okay, so the levy powers will be with the center. Article 269 says the levy powers are with the center. So the center used to levy a tax which is the central sales tax. Before GST, the center used to levy this tax called central sales tax. So the central sales tax is also called as an origin tax. Why origin tax? Because the tax, though it is levied by the center, the revenues that were collected, let's say the center is collecting some 5,000 rupees, this money goes to the exporter state. This money was going to the exporter state. I hope it is clear. This is what we have discussed. There was some 1 or 2 days gap, so that's the reason. Is this clear? Okay, so the money was going to the exporter state. Now, now GST has made 101st Constitutional Amendment Act. You have Article 269A. Now this Article 269A is also mentioned in this Article 270. See, Article 270 says all the taxes will be made part of divisible pool, okay, except those which are mentioned as part of Article 270. Except those which are mentioned in this 270, everything else should be made part of the divisible pool of taxes from where the center is going to share its revenues with the state. And in this Article 270, we have talked about whatever is mentioned in Article 268. So Article 268 talks about all those taxes which are levied by center but collected and appropriated by states. Okay. Then Article 269 levied. Article 269 talks about all those taxes which are levied and collected by center but distributed to states. This is Article 269. And then Article 269A is also part of this. Article 269A. So this is Article 269A. So Article 269A basically talks about this system which is called as the IGST system. Okay. So whenever there is interstate trade, so this is the example, Maharashtra to Arunachal Pradesh, Tata Nano, they are exporting. Okay. Now the question comes up, who is going to levy IGST? Center. Because Article 269A, it's an extension of this article. Interstate trade as such is part of union list. So whether it is IGST or whether it is CST, the levy powers will be with center. So the center is going to levy IGST. That should be clear. So Article 269A clearly says, whenever there is interstate trade, the levy powers are going to be with the center. Levy powers will be with the center. Okay. Second important aspect it says is, now let's try to understand, let's say IGST, I said it's a system. It's a system and IGST includes both CGST plus SGST. Okay. So both put together, let's say this is some 2.5%, this is 2.5, which is levied. IGST is levied by the center and let's say 5,000 rupees is collected. Okay, listen very carefully. 5,000 rupees is collected. Now this 5,000 rupees which is collected, Article 269A says this money will be maintained outside the consolidated fund. Heard of this? Heard of this word in your polity class? Consolidated fund? Okay. The word has come, no? Okay, so all the revenues, there is center's consolidated fund. Similarly, states have their consolidated fund of states. So any money that has to be removed from this consolidated fund of India, you need the approval of Parliament. Any money you have to remove from the consolidated fund of India, you need the approval of Parliament. Okay. So this article says this money will be maintained outside the consolidated fund. Outside. Logic is very simple. Why are they maintaining it outside the consolidated fund? Because again you have to share it with the states. No. Anyhow, again you put it in the consolidated fund and then again you need an act of Parliament, then remove money, then give it to the states. Why that headache? Okay, so better put it outside the consolidated fund. It is neither part of the consolidated fund of India nor part of consolidated fund of state. It is put outside the consolidated fund of India as well as consolidated fund of state. This is the first thing. Okay. And how this 5,000 will be distributed? How this 5,000 rupees will be distributed? This will be decided. The procedure how it will be distributed, this will be decided by a council which is called as the GST council. So how this 5,000 rupees will be distributed among the state and center, all these procedures will be decided by GST council. So GST council will decide, how the money is going to be distributed. Okay, is that clear, everybody? Now in this 5,000, let's say center 2.5, 2,500 the center is taking, 2,500 rupees center is taking. Now another 2,500 should be given to the state. So this 2,500 goes to the importer state or the destination state. GST is a destination based tax. So that money to 2,500 is going to Arunachal Pradesh. I think it is clear. Now the question comes up from the beginning, the developed states, especially very few states have protested, and one of the state which always used to protest is Tamil Nadu. So earlier Tamil Nadu, Amma was there, Amma is no more. Okay, so Jayalalitha madam was there. So she said, how much should be the tax on coconut? We know. You don't tell us, sitting at the center. So how the coconut should be taxed? Okay, so states know better than you. So what should be the tax? Protests were very limited initially. Okay, so protests were, Arun Jaitley, when he said it was something like all the states have accepted, so no states have protested for GST. Initially some states showed some protest, but mainly Tamil Nadu was not happy. And good states, which are exporter states. Tamil Nadu is an exporter state. Similarly, Gujarat is one more exporter state. Okay, so Karnataka was also exporter. That means they produce and they sell. Maharashtra was also an exporter state. So these bigger states who were exporter states, they were not happy with this procedure. Why? Because earlier Maharashtra was getting some 5,000 rupees. Okay, so when it is exporting a product, but here that money is not coming. The proceeds which they used to get because of CST is not coming to Maharashtra in this particular IGST system. It is, some amount is going to the center and some amount is going to the Arunachal Pradesh. So the bigger states were not happy and the exporter states were complaining. And government said, don't worry, first 5 years after implementation of GST, we will compensate you. We will compensate you, don't worry. We will compensate you for the first 5 years, that is till 2022. We will compensate you if you are losing revenue. So earlier Maharashtra was getting 100 rupees. Now because of GST you are getting only 75 rupees. Don't worry, we will compensate that 25 rupees for you. Okay, the first 5 years that compensation will be done. And they said we will compensate through GST compensation cess. They came up with a new cess called as GST compensation cess. So using this, I'll talk about this after some time. Otherwise, I'm not interested in GST now. GST, I'll come to GST after the terminology is over. So GST compensation cess, through this GST compensation cess, we will try to give you the money for the next 5 years. So don't worry about the loss. This is how the exporter states, the bigger states were said, okay, don't worry, don't worry. Is this clear? Understood? Okay, fine. Okay, so this is how the procedure happens. Okay, IGST system happens, and this is before GST. This is our 269A. So this article 269A basically talks about IGST system. IGST system. Remember two things here. Article 269A, IGST. I'll make you write later. When I'm making you write GST, I'll make you write this also. So 269A, the proceeds will be shared outside the consolidated fund. The proceeds will not be part of the consolidated fund, and how it will be shared will be decided by, all this is mentioned in the article itself. I hope it is clear. Yes. No, IGST, that money will not be pushed. So that 5,000 will not be pushed into the consolidated fund. Okay, so is this clear? Okay. So article 269A. Okay. So did I make you write anything about IGST? No. Oh, okay. So just write down. IGST is a system. IGST is a system under article 269A. IGST is a system under article 269A. Is that okay? Continue writing. IGST proceeds are shared. IGST proceeds are shared outside the consolidated fund of, outside the consolidated fund, just write outside the consolidated fund, outside the consolidated fund, and the sharing mechanism, and the sharing mechanism will be decided by GST Council, will be decided by GST Council. Is that okay? That's all. Now listen, so one more thing here is even cesses and surcharges. Listen very carefully. Cess and surcharge will also not be shared with the states. So the proceeds of cess and surcharge. So everything else will be made part of divisible pool, including the corporate taxes, including the corporate tax. But those mentioned here will not be made part of the divisible pool. Okay, so you understood what it has and what 269A. Similarly, cess and surcharge. Okay, these cess and surcharges are also not included or not shared with the states. They are not put in the divisible pool. Okay. Now, how does a cess or a surcharge work? That's the next thing. So, central government cess and surcharges will not be made part of the divisible pool. So, we had a simple understanding about this chart. Okay, this is the new IT slabs. So 0 to 3 lakhs, we understood what is tax exemption and rebate, right? Okay. Now let's say above 15 lakhs, let's say income is 30%. Okay. Let's try to understand how it works. Okay. Okay. See here, let's say my income. Is this color okay? Let's say my income is 75 lakhs. Okay. Income is 75 lakhs. This is the taxable income. So per annum, taxable income. Okay. Now this 75 lakhs, on this 75 lakhs, I have to find out what is the tax liability. What is the tax liability? It's not that straight all the 75 lakhs I have to pay. So for example, up to 3 lakhs, there is no tax. Then next 3 lakhs will be taxed at 5%. Next 3 lakhs is taxed at 10. Okay, so next 3 like that you are taxing. Okay, 3, 6, 9, 12 over. Okay, another 3, 15 is over. Okay, so another 50 lakhs is left. Okay, so this 50 lakhs will be taxed at a rate of 30%. Okay, 60 lakhs is taxed at a rate of 30%. And you add up all that, you add all this. So I'm going to add all this. So you're going to get a value, no? So this is your, it is 3 lakhs, there's no tax. Next 3 lakhs, you're taxed at a rate of 5%. Then next 3 lakhs, you're taxed at a rate of 10%. Another 3 lakhs, you're taxed at a rate of 15. Another 3 lakhs, you're taxed at a rate of 20%. Okay. And then whatever is left out, something like 60 lakhs, I'll be taxed at a rate of 30%. Okay. Now let's say my tax liability comes up to, just an example, the tax liability has come up to like some 2 lakhs or something. Just an example here, or some value. Okay, some value. Okay. On this, now as my income is more than 50 lakhs, this is a case where my income is more than 50 lakhs. So whenever income is more than 50 lakhs, there is something called as the surcharges which will come into picture. Surcharge. Surcharge is not for everybody. Surcharge is only for those whose income crosses a particular limit. So surcharge from 50 to 1 crore, 50 lakhs to 1 crore, surcharge is, let's say, 10%. Then again 1 crore to up to 1 crore, then more than 1 crore up to 2 crores, again it will be 15%. Okay, like that. Okay, so highest surcharge today that is existing in the new budget is 25%. Highest surcharge is 25%. Are you able to get this? So now surcharge is what? Tax on tax. Okay, so that you are reducing the disparity between rich and poor. That is what is surcharge. So this surcharge, this is my tax liability. Surcharge is not on 75 lakhs. Surcharge is not on 75 lakhs. Surcharge is on my tax liability. After the calculation, the tax liability is this amount. Let's say this amount is X. So on this, there will be surcharge. Okay, so this will be something like this is 2 lakh plus 10% of 2 lakhs. Is that clear, everybody? So now I have arrived at a value. Okay, so something like 2,20,000. Okay, I have arrived at a value. On this value, first surcharge is levied. Okay, then on this value, government comes up with levying something called as cess. On this value, government comes up with levying something called as cess. Are you able to follow? Okay, so I'll again make it very clear. There should not be any confusion here. Very simple. First surcharge will be levied. You should first know the difference between cess and surcharge. So after calculation, I said this is the income and some income, and after that we have arrived at a tax liability. Okay, on this tax liability, since my income is more than 50 lakhs, 50 to 1 crore, let's say the surcharge is 10% surcharge. Okay, so on this tax liability, there should be something like surcharge. Okay, that is levied. Surcharge is like 10%. Okay, now I have arrived at a value. Okay, on this, there is something like education cess, education and health cess, health and education cess. Health and education cess. Is that clear, everybody? Okay, so on this there will be health and education cess, 4% on this. So that is how the value is calculated. So to one observation here, this surcharge, okay, this surcharge will come into picture only for those whose income is beyond a particular level. Suppose my income is only 30 lakhs. Okay, not 75, instead of 75. Okay, income is only 30. Okay, that means now I will calculate the tax liability. I will be calculating 3 lakhs I will calculate, and that I have arrived at a value. This is my tax liability. This is the tax liability. Let's say this tax liability is some 50,000 or whatever it is. On this, will there be surcharge now? No surcharge, because your income is less than 50 lakhs. That means surcharge is not on everybody, but there will be what? Cess. There will be cess which will be levied. There will be cess which will be levied, because cess is on everybody. Cess is on everybody. Surcharge is not on everybody. First thing, it should be clear. Okay. And the proceeds which they collect, that is basically, what is the basic difference, we'll try to understand. Cess and surcharge. So surcharge related details are clearly mentioned in Article 271, clearly specified in this article. Okay, Article 271 talks about surcharge, which says it is tax on tax to reduce the disparity between rich and poor. And in India, surcharge is starting when your income crosses 50 lakhs. The budget says maximum surcharge today is 25%. Maximum surcharge, because previous budget, maximum surcharge was 37. previous budget, maximum surcharge went up to 37. Now they said maximum surcharge was brought down to 25 maximum. That is the maximum. Upper limit 5 crores. Upper limit 25%. Okay. Is this clear? This surcharge proceeds will be made part of consolidated fund of India. Surcharge it is collected, that money will be made part of the consolidated fund of India. Okay. Now what is this surcharge? It is basically a tax. It is a tax on tax. Tax on tax. Okay. To reduce disparity, reduce the gap, reduce disparity between rich and poor. This is the understanding. Reduce disparity between. Okay. And this surcharge will not be shared with the states. Will not be shared with the states. And that is why it is visible in Article 270. It is visible in Article 270 because you are not sharing it with the state. UPSC will not ask that calculation. This is for understanding. So you should know on what it is levied. You know, generally read on if my income is 1 crore, is it levied on 1 crore? No. Surcharge is not levied on 1 crore. Is that clear, everybody? Okay. Now, cess. Details related to cess are not separately there. Cess related details are mentioned in Article 270. Okay. Now, cess is levied for a specific purpose. It cannot be spent on anything other than this purpose. But surcharge can be spent for anything. Surcharge can be spent for anything. That money which the center is getting, it can be spent by the center on anything. But cess will be spent only for that purpose. For example, if I say education, primary education is 1% and secondary education 2%. Education and health cess put together. Let's say if I say this is primary education and health cess is 4%, this money which center is collecting should be used for this purpose only. Similarly, if I say Swachh Bharat cess, Swachh Bharat cess, Krishi Kalyan cess for farmers, Swachh Bharat cess for Swachh Bharat, that means you are using it for a specific purpose. Now, cess generally what happens is, first it goes into the consolidated fund, but immediately it will be removed. It will be transferred into that account where it is, for example, Pradhamik Shiksha Kosh related to primary education. Okay, so first the money goes into the consolidated fund, but from there it will be immediately shifted to the Pradhamik Shiksha Kosh, primary education, whatever they are spending on primary education, it will be shifted. And this will be part of public account. That's not over for us. So there are different funds. Consolidated fund is one. In polity, you'll do it in detail. See, consolidated fund is one. You have contingency, and you also have public account of India. Public account of India. Okay, different funds are there. In detail, you'll be discussing in polity. For this, if you have to remove money from this fund, you need the approval of Parliament. That much should be clear. All the taxes which government is collecting, no, center, it is going into this consolidated fund. Okay. Contingency, the word itself is emergency. So president will deal with that contingency. So whenever there is tsunami, earthquake, etc. Okay. So president wants to spend money. Now money can be pulled out from the contingency. And after the money is spent, again you'll put it in front of Parliament for approval. But contingency is what? Emergency. No approval of Parliament is required. Executive decision is sufficient for public account. No approvals are required, Parliament approval. So like this, consolidated fund is clear. So don't worry about other things. So consolidated fund is clear. So once the money goes into consolidated fund, then it is pushed into whichever fund which is there. So Pradhamik Shiksha Kosh, you are shifting it. Now this is something part of the public account. Public account. No approvals required. From there, they will spend money for education or whatever required thing is. And even cess proceeds. Cess proceeds will also not be shared with whom? States. Cess proceeds will also not be shared with the states. Is this clear? So these are the things that are there in Article 270. I hope it is clear. Okay, so that Yeah. So there's nothing like there, you don't have a specific body which decides if there is a dispute also. You have to, for example, you don't have a specific authority which will say we will resolve the issues with respect to taxing. There's nothing like that. So it is amicably they have to decide on. Okay, they can't keep on fighting with respect to. I think till there it is clear, and just so next put the heading cess and surcharge. Cess and surcharge. As per Article 270, as per Article 270, cesses and surcharges, cesses and surcharges are not made part of, are not made part of, are not made part of the divisible pool of taxes, are not made part of the divisible pool of taxes. That is, the center will not share, the center will not share cess and surcharge proceeds with the states. Cess and surcharge proceeds with the states. With the states. Okay. Then put the heading basic differences between cess and surcharge. Difference between cess and surcharge. Okay. Under cess, just write down. Under cess, just write down. Cess is levied for a specific purpose. Cess is levied. Make a table and write. No. Cess is levied for a specific purpose. That is same point. That is, cess proceeds cannot be used. Cess proceeds cannot be used. Cannot be used. Cannot be used for other purposes. Other purposes. Example. Education cess proceeds should be used for education. Education cess proceeds should be used for education. Okay. Next, come to surcharge. Article 271 clearly defines surcharge. Article 271 clearly defines surcharge. Okay. Surcharge is a tax on tax. Surcharge is a tax on tax to reduce disparities between rich and poor. Okay. Just write down, continue. In India, surcharge is levied on incomes above 50 lakhs. In India, surcharge is levied on income above 50 lakhs. Income above 50 lakhs. Is that clear, I think? Okay. Now, Next point, write down. Cess proceeds will not be shared with the states. Cess proceeds will not be shared with the states. Okay, write the same point here. Surcharge proceeds will also not be shared with the states. Surcharge proceeds will also not be shared with the states. Is that okay? Okay, so then one more point to be written is, see, surcharge, no, cess is that government will decide. Surcharge basically, there is a upper limit. Okay, so cess, government will decide what would be the cess in the budget. As decided in the budget, you go accordingly. Okay, now just write down surcharge, write down surcharge is levied on tax liability. Surcharge is levied on tax liability. Surcharge is levied on tax liability. Tax liability is not the taxable income. I think it is clear. Surcharge is levied on tax liability. Is that okay? Here, cess, okay, cess is levied on cess is levied on tax liability plus surcharge. Cess is levied on tax liability plus surcharge. If surcharge is 0, no problem. Surcharge, if the income is less than 50, then this will be 0. Okay, but it says is levied on tax liability plus surcharge. Okay, I think it is clear. Understood? Huh? Yaar, cess is on everybody. Cess is on everybody. Your taxable income, suppose your taxable income is 10 lakhs also. Okay, you're not, that means you'll have a tax liability is there. Let's say your tax liability is something like 20,000 rupees. But surcharge will not be there, this will be 0. Because surcharge will only come when your income is above 50 lakh. So then cess will, 4% cess will be levied on the tax liability. This is 0. I think you're getting my point. So first, surcharge will be levied. If the surcharge is there, it's okay. Okay, if surcharge is not there, it is 0. Tax liability have arrived. On the tax liability, there will be what? Cess. So cess is on everybody. If your income is less also, cess is there. Your income is 5 lakh, 10 lakh. 5 lakh of course government says rebate and all. So your income is 8 lakh, 10 lakh, 12 lakh, whatever it is, you will have cess. That should be clear. Okay, understood. Yes. Did we write the definition of tax base? Okay. Huh? Done, no? Tax base. Okay, then so terminology, this is about some articles only. We will not dig deep into the articles. Other articles you will read in your polity. I am only interested in the taxing part, that's all. Okay, so next put the heading cascading effect. Cascading effect. See, cascade, somebody was asking, is cascading effect cess? No. Cascading effect is a method and mechanism which is increasing your tax. Is that okay? Don't get confused. Okay. So cascading effect, it is nothing, it is a tax on tax. Write down. It is a tax on tax. It is a tax on tax. increasing the cost of production. Increasing the cost of production. Okay. It is seen as an inefficient tax mechanism. It is seen as an inefficient tax mechanism. Inefficient tax mechanism. Clear? Okay. Next. That's it. And that mobile phone example. Just mention example mobile phone. Later on you can refer to. Okay. Next, put the heading tax evasion. You know this already. Tax evasion. Write down tax evasion. Words. Yeah. हाँ basic class में लिखवाया था याद है. Yeah. I know I've discussed tax evasion and avoidance. No. I know. I have a clear structure. I remember. Tax evasion लिखो. It is an illegal activity. It is an illegal activity in which a person or entity deliberately escapes from paying tax. Deliberately escapes from paying tax. And I gave you examples and we have discussed, all that is clear, I know. Then put the heading tax avoidance. Okay, write down. It is the use of legal methods. It is the use of legal methods. To minimize the amount of tax. To minimize the amount of tax liability. To minimize the amount of tax liability by an individual or a business by claiming as many deductions as possible. By claiming as many deductions as possible. Okay. Okay, there are two cases here. One is, let's say Vodafone India is selling shares to Vodafone Mauritius. Remember this? Okay. So Vodafone India selling shares to Vodafone Mauritius, and Mauritius is basically a tax haven. We have written the basics class. What is it? Tax haven. Okay, so here Vodafone India is selling shares to Vodafone Mauritius. Okay. Now remember, when you are selling some assets, that asset can be a building, that asset can be even a financial asset. Okay. So there is a tax which is levied by the government, which is called as the capital gains tax. This tax is also in the union list. That means the levy powers will be with the center. Okay. Capital gains. The word itself is what? Capital gain. That means you will pay this tax only when there is a gain. Only when there is a gain. For example, suppose I have purchased this building for, let's say, 10 crores, and after 2 years you sold this building for 20 crores. What is the capital gain? As a seller, I am a seller. I sold it after 2 years. Okay. I have sold it after 2 years, and as a seller I have got a gain of how much? 10 crores. Since I've got a gain, on this gain, as a seller, I have to pay a tax called as capital gains tax. So this tax will come into picture only when there is a gain. Only when there is a gain, not when there is a loss. So when there is a gain only, because the word itself is what? Capital gains tax. So it comes into picture only when there is a gain. Now this can also be for a financial instrument. For example, I have purchased shares today. After 10 days or after 20 days or after 6 months, I purchase shares worth 1 lakh equity and I have sold it for 2 lakhs after 3 months or 6 months. Now, this is a financial asset, not a physical asset. But on this financial asset also, I have got a gain of how much? 1 lakh. As a seller again, as a seller. That means, who is paying capital gains tax? Seller. Seller is paying this capital gains tax. So, as a seller, now I should be paying this tax called as this capital gains tax on this 1 lakh. Are you able to get this? I have to pay capital gains tax on this 1 lakh as a seller because I've got gain. Now, for suppose, if I have purchased the shares for 1 lakh, but I sold it for 50,000. Finish. Okay, it can happen. It can happen now. Okay. So that what happened now in this case? Did I make a gain? No, this is loss. So when I make a loss, nobody should come and ask, no, I already made a loss, now you ask me capital gains. I'll not pay obviously because capital gains comes into picture when there is a gain and here there is a loss. So I'm not liable as a seller to pay any capital gains tax. As simple as that. Okay. So capital gains tax can also be levied on paintings and some assets like antiques. Picasso, there are lovers for this art and they are sold at millions of dollars. I don't know what they see in the paintings, but common man cannot understand. Only you should have that artistic thought process and heart. So on those items like antiques also, capital gains tax can be levied. Mahatma Gandhi spectacles, suddenly you get it, you discover it, you go. You auction it, you get money. Okay, so on that also CGT can be levied. Is that clear? Okay. Vodafone is one company which is always in conflict. Okay, Vodafone, let's say, original price of the share, listen very carefully, original price of the share is something like 500 rupees in India. Now, let's say Vodafone wantedly has sold these shares at 450. And it has sold these shares to its own sister. This is Vodafone. It is sister. Sister is something like two known companies. Now this pricing which you see, this pricing mechanism between two known entities, these are known entities. So this pricing mechanism between two known entities is called as transfer pricing. Pricing mechanism between two known entities is called as transfer pricing. It is Vodafone and Vodafone, therefore it is able to sell it at 450. Transfer pricing is known entities. If it wouldn't have been Vodafone, if it would have been Airtel, then probably Vodafone wouldn't have sold it at 450. So transfer pricing is used as a mechanism for tax avoidance or shifting the profits from India to Mauritius. Okay, so you sold it at a lesser price and you have not got any gain here. So when the income tax department asks, why are you not paying capital gains tax? They'll clearly say, go refer back to your basics. We have made losses, will not pay. That is the rule of capital gains. But Mauritius, it can sell these shares in Mauritius at a higher price and get the gains. In the books of Mauritius, you don't have capital gains. In the books of Mauritius, they have removed this tax long back. So they have not paid capital gains in India. They have not paid capital gains in Mauritius, but ultimately transaction is over through a mechanism called as transfer pricing. Through a mechanism called as transfer pricing. This is a clear case of tax avoidance. It's a clear case of tax avoidance. Okay. Is this clear? Okay. So similarly, this in the similar fashion, there was this case. I think I mentioned Vodafone and Hutch. Okay, Vodafone and Hutch. This was a very famous case. Vodafone has acquired Hutch. Yes or no? Okay, today you don't have Hutch. It is only Vodafone, and Vodafone has acquired Hutch, but Vodafone did not do the transaction in India. Vodafone has done a transaction in a tax haven called Cayman Islands. In this Cayman Islands, there is one shell company. Did we write this word shell company earlier? Okay, shell company. This shell company was holding some stake in Hutch, 67% stake in Hutch, and Vodafone has acquired this shell company, and that's how Vodafone became the owner of Hutch in India. Now, this is also a clear example of what? Tax avoidance. Is this clear? Okay, so write down tax avoidance. Done, no? Tax avoidance is done. Okay, then example, Vodafone and Vodafone case. Just write example, Vodafone case. Okay, then put the heading transfer pricing. Transfer pricing. Okay. It is a pricing mechanism. It is a pricing mechanism between two known entities. Two known entities. In bracket, just mention between related legal entities. Between related legal entities. Related legal entities situated in different countries. Situated in different countries. Situated in different countries. Okay. Then write down. Transfer pricing is used as a mechanism transfer pricing is used as a mechanism to shift profits from countries with high tax rates to countries with low tax rates. Okay, low tax rates, in bracket write tax haven. Close the bracket. So basics class, I'm not defining tax haven, you know tax haven how it works. Okay, then put the heading base erosion and profit shifting. Base erosion and profit shifting. Okay, write down. Companies shift their profits to other tax jurisdictions having lower tax rates thereby eroding tax base in India. Okay, is that clear? Okay. See, shell company, did we define it in the basics class? Okay, so that's not required. And then next, Okay. Next one is tax buoyancy. Okay. Okay. Let's try to understand. What does this tax buoyancy indicate? It indicates changes in tax revenue, change with respect to tax revenue, okay, induced by changes in GDP, induced by changes in GDP. Okay, let's try to understand this. Okay, so what is this tax buoyancy? It is the proportionate change, delta is change, okay, with respect to tax revenue, proportionate change in tax revenue to proportionate change with respect to GDP. Okay. Now, let's try to understand. Logic is very simple. Whenever economic growth is increasing, there's more production, there's more GDP growth. Obviously, in line with the GDP increase, there should be also increase with respect to what? Tax revenue. You're producing more, your output is increasing. So, in proportion to your output, tax revenue should generally increase. So, growing economies generally will have higher tax collections. Growing economies generally will have higher tax collections. But is it always a norm? There is nothing like a norm. Okay, is it always a norm? Need not be. Okay, so why? Because there can be certain countries where, GDP is increasing, but the tax revenues are not increasing. Or GDP is increasing by some proportion, but tax revenues increase is less than the increase with respect to GDP. This can also happen. When this can happen? When there are too much of tax exemptions. GDP is increasing, but there are too much of tax exemptions. Some words here. It can happen when? It can happen when there is too much of tax exemptions given by the government. Or if companies resort to too much of tax avoidance. Or there is inefficient taxing policy, you have challenges of cascading effect. Or if it is a tax heaven, where the growth is coming because of your tax concessions only. Okay, so it is possible that in these cases, okay, or there can be something called as tax expenditure. Okay, tax expenditure. I've used a word called tax expenditure. Now another word, tax expenditure means it is nothing but revenue foregone. Revenue you have foregone because of tax concessions. Revenue foregone because of tax concessions. You have given too many tax concessions. Because of the tax concessions, government is losing revenue. That is called as revenue foregone because of excessive tax concessions, tax holidays. Tax holiday means holiday for next 5 years, need not pay tax. It's a kind of a tax holiday. Okay, so that is what is called as tax expenditure. Tax expenditure is nothing but revenue foregone because of tax concession. This tax expenditure was a challenge mainly with respect to a tax called as customs. So after 1990, government said, let's give lot of discounts and concessions with respect to customs. So because of this, the revenue collected because of customs, let's say, is 2.5 lakhs. Revenue foregone is 5 lakhs. Revenue collected is 2.5 and revenue foregone is 5. That means you have lost more than what you have collected. Now this is a challenge of excessive concessions. You give too much of concessions now. So then revenue collected by the government is going to be less, or your tax expenditure will be more. Tax expenditure is nothing but the revenue that is foregone because of tax exemptions or tax concessions. So too much of tax concession is also not good. You're giving too much of tax concessions because of which government is not able to get back the revenue. So on a general note, obviously whenever GDP is increasing, a growing economy, then the change with respect to tax revenue, there will be higher tax revenue collections. I think it is clear. Okay. So what does, if I have buoyant taxes are those taxes when the GDP is changing, the tax collections will be higher than the GDP change. GDP is growing by 10%, but my tax collections are growing by 20%. That means my taxes are more buoyant. That is the meaning. So if GDP is increasing by 10, but the tax collections are increasing by 20%, that means I have buoyant taxes. But if you don't have buoyant taxes, probably GDP is increasing by 10, but your tax collections are just increasing by 5%. Increasing by 5%. That means tax buoyancy is less. Are you able to get this? Now, one more observation here. If this increase or change in tax revenue that is happening, change in tax revenue can be because of automatic change. This is automatic change. That is automatic is basically more consumption happened, more people started buying goods, more production happened. So automatically the tax collections have increased. That is called as automatic change. At times tax collections also can increase or decrease because of discretionary changes. Discretionary changes. So discretionary changes is something like government has specifically brought in some changes with respect to the taxes. For example, let's say government has reduced the corporate tax rates. So let's say government said corporate tax we are reducing it from 30% to 22%. Now this is a discretionary change. Discretionary change, specific change. So this discretionary change can reduce the tax collections for the government. This reduction of tax rate from 30% to 22% is not an automatic thing. It's not automatic. Government has brought in a discretionary change means what? It has brought in a change specifically with respect to a tax called corporate tax, where it has reduced the tax rate. It is not a normal one. It is a normal change. It did not increase. It's a discretion of the government. Are you able to get this? Okay. It can be something, a discretionary change can be something like introducing GST. So in 2017, earlier there was no GST. So now government came up with GST. Now this is also a discretionary change. So tax collections for the government can increase because of discretionary changes. Tax collections for the government can also increase as an automatic situation. Automatic situation, for example, after COVID pandemic, after the second wave, when we recovered after the second wave, okay, so people started consuming, people started spending more, so automatically GST collections also increased. That is basically an automatic change. We all start consuming more, then automatically the tax collections will increase. GDP will also increase. But there can be some tax collections which can change because of discretionary changes. Discretionary change. Discretion is something which government has taken a specific decision with respect to increase of rates or reduction of rates. It can also be with respect to new tax policy. GST is a new tax policy. And the new tax policy can either increase the tax revenue or decrease the tax revenue, whatever it is. So that new tax policy which government has introduced is a discretionary change. Is that clear? Understood? Okay. So tax buoyancy, let's say just an example here. Okay. Now GDP, change in GDP is, let's say change in GDP is 10%. Okay. Change in GDP is 10%. Proportionate change in tax revenue. Proportionate change in tax revenue, okay, is, let's say 20%. 20%. Okay. In this 20%, let's say 10% is automatic change. 10% is what? Automatic increase. Another 10% is because of discretion. Okay. But overall it has increased by 20. Okay. So 10% is automatic. Another 10% is a discretionary change. Okay. So now tax buoyancy. So tax buoyancy is, it is change with respect to the tax revenues to the change with respect to the GDP. So this is 20, like 20 by 10. So tax buoyancy is 2. Is that okay? Tax buoyancy is 2. Is that clear, everybody? Okay. So but 10 is because of automatic and 10 is because of discretion. More buoyant taxes, it is always better. See, UPSC asked a question which was, I can say it's a dicey question. There are several dicey questions which will be asked by UPSC. There was one dicey question in monetary policy also. Monetary policy, there was a question, it goes like this. And we are not, whenever UPSC gives a key, okay, and you know the answer, you find the concept is wrong. Suppose, it is possible, UPSC is not God. So in the next time when the question comes up, I will go according to what? UPSC key. You will not use your brains. You will not use your head. It's purely UPSC has come up with an answer earlier, so I will go according to UPSC previous answer. As simple as that. No using intelligence here. So for example, there was this question earlier, which I exactly don't remember the question, but I'll try to frame few points like, which of the following statements are right with respect to reserve requirements? Some student also brought it to me recently also. Okay, reserve requirements. Reserve requirements means SLR, CRR, okay. And there were options, okay, there were options given. Okay, one option was something like to reduce the profitability of the banks. To reduce the profitability of the banks. It goes like this. There is one statement which says, okay, to make the depositors' money safe and liquid. To make the depositors' money safe and liquid. And there's one more option to control, exactly I'm not able to get the terminology, to control the loans and advances given by the banks. To control the loans and advances given by the banks. And there's one more option which I'm not able to recollect. Okay, that's not the answer. It's not there. Any other options? Some useless option. Okay, so there's something that option. Now there's 1 and 2, 1, 2, 3, 1, 2 and all that. Okay, the answer for that was 1 only. Okay, that 1 only was to not profitability, not reduce profitability, to have some control over the loans and advances of the bank. Okay. Now the second statement is also there, 1, 2. That 1, 2 is, the second statement was to make the deposits of the bank safe and liquid. Now when I read it as an English line, what is the problem? To make the depositors' money safe and liquid. But that is not there in the key. It's not there as the answer. Safe and liquid. Maybe UPSC logic is it makes the deposit safe, but not liquid. Now I should think that way in the exam. It's not possible. In the exam hall, you want me to think that way, to make the depositors' money safe and liquid. In fact, SLR and CRR reserve requirements are mainly for creating some safety for depositors, not mainly to control loans. Of course, loans will get automatically controlled if CRR or SLR increases, but that is not the main objective of reserve. No, reserve requirements are mainly to prevent bank runs. Bank run, suddenly all the depositors come and ask for money, then the bank may get into trouble, no? And so to handle that trouble, you have reserve requirements. So now that means loans is not the primemost thing there. Okay, it's a secondary objective. But the primary objective which he has given is to make the deposits or money safe and liquid. Safe and liquid. Safe and liquid. But that's not there in the key. Safe and liquid. Is that clear? And don't think, oh, how? One question. No, leave it. See, sometimes it happens like in the exam hall generally, now after seeing the key, we can give 101 reasons. This is the answer, you know. Okay, so this is how it goes. Safe and liquid, what is the problem? To make safe and not liquid, no. Safety is there, but liquidity will get reduced. But UPSC, if it would have given a different option, no, safe and liquid, it's okay. Then your way you explain that question changes. So at times, there will be such questions. So what is the best thing you have to do with such questions is, already you see the answer. Next time it comes up, mark the same. Mark the same. Very important, mark the same. If there is a discrepancy between what we study and NCERT, जो भी NCERT में है, that is the answer. I think you're getting my point. These are the few things, nothing wrong, because NCERT is a standard. Okay. Now, like this, there was one more question. Okay, there was question here. Okay, tax buoyancy is clear, right? I'll make you write after 2 minutes. So there's one more question. Increasing tax rates, growing economies have higher tax revenues. Growing economies. Okay, so have higher tax, see, growing economies have higher tax to GDP ratio. Growing economies have higher tax to GDP ratio. Now, if I give you this statement, growing economies have higher tax to GDP ratio. There were some math students who are too intelligent. So they said growing economies means denominator is increasing. Okay. The denominator is increasing. So fraction should reduce. Okay, so statement wrong. Okay, but no. Growing economies generally have what? Higher tax to GDP rate. Don't complicate. Growing economy, and the economy is growing, tax collections generally tend to increase. This is one. Now, growing economies have higher tax to GDP. No, growing means denominator is increasing, so fraction should decrease. That thought process doesn't work out here. That is why solving old questions is very important to understand the mind of UPSC. I think you're getting my point, right? Okay, so growing economies have higher tax to GDP ratios or higher tax collections. That statement is right. Okay. Now there's growing economies or higher tax to GDP ratio, higher tax collections or higher tax to GDP ratio will indicate equitable distribution of wealth. Higher tax to GDP ratio will indicate equitable distribution of wealth. Equitable distribution of wealth. Is that statement, what is equitable? You know what is equitable distribution of wealth, right? So, will that indicate equitable distribution of wealth? This will not indicate equitable distribution of wealth. Why? Because suppose Shah Rukh Khan and Salman Khan and Amitabh and Tatas and only they are paying the top bracket and still tax to GDP can increase. It's not required that there is equitable distribution of wealth. Just because you get more tax to GDP or just because your tax buoyancy is increasing at a faster rate, you cannot comment on equitable distribution of wealth. I cannot comment on equitable distribution of wealth based on tax buoyancy. Based on tax buoyancy, probably I can comment on something like growing economies. I can comment on growth, but I cannot comment on equitable distribution of wealth. I think you're getting my point, right? See, the lower sections, they have lost their jobs, they did not pay taxes much. The lower sections are struggling, but the top 30% bracket, above 30% bracket. Now 30% bracket, all the tax collections are mainly coming from them. If that bracket increases their tax revenues, also income taxes, my tax collections can increase. I think you're getting my point. But the lower sections are not paying, then how can you talk about equitable distribution of wealth? Is that clear? That's not, there's no problem with respect to that. Is that clear? So you'll find, so very specific questions, few questions only, 1 or 2 questions here and there will be. But growing economies, tax to GDP, yes, tax collection, growing economies generally will have higher tax buoyancies, higher tax to GDP. But at times now, one student was saying, sir, if we are in Mauritius, then how? No, you are in India. Okay, so if you are in Mauritius, because of tax concessions, GDP is increasing, but tax is reduced, then how can you comment? So don't think too much. You are in India, you will only take 1 and 2 factors only. One is tax, another one is GDP. There are only 2 factors. I can't take 10 factors. I don't have an Excel sheet to solve the problem now. If I say it is in a tax 7, that's 1 factor. Like that, if I have multiple factors, then I need an Excel sheet. There are only 2 factors. One is tax, another one is GDP. When I take these 2 factors, growing economies, there will be higher tax revenues. That's it. That's how you go ahead in the exam. Is this clear? Yes, the word tax buoyancy is clear. Okay. Now, wait. So, before we write that, there is one more word. which is called as tax elasticity. Okay, so buoyancy is clear. Now this is basically, it measures the proportionate change of adjusted tax revenue. Adjusted tax revenue, proportionate change of adjusted tax revenue. This A is adjusted tax revenue to the proportionate change with respect to GDP. Okay. In that previous example, adjusted tax revenue will only take automatic change. Adjusted tax revenue means it will only take the automatic change. It is not going to consider the discretionary change. That is, this is a change in tax revenue, or adjusted tax revenue means out of the total tax revenue, I am subtracting the discretionary tax increase because of discretionary changes. I think it is clear. Out of the total tax revenue, so adjusted tax revenue, this adjusted tax revenue is nothing but out of the total change in tax revenue, I am subtracting the change in taxes because of discretion. Because of discretion. So here I will only be taking the change in the tax revenue because of automatic aspect. Because of automatic aspect. I think it is clear. Okay. So in this example, tax elasticity, so it is basically 10, that this is not taken. So this was 10, no? 10%. And GDP change was also 10. So tax elasticity in that example is 1, but tax buoyancy in that example is 2. Remember tax change here we took 20 there, 10 with respect to automatic and 10 with respect to discretion. This is the difference between tax buoyancy and tax elasticity, two different words. So put the heading tax buoyancy. It measures actual or observed change in tax revenue. Actual or observed change in tax revenue. Actual or observed change in tax revenue relative to GDP. Okay. So then write tax buoyancy is equal to in the numerator write proportionate change in tax revenue. Proportionate change in tax revenue divided by proportionate change in GDP. Proportionate change in tax revenue divided by proportionate change in GDP. Okay. Below that, right, delta T is equal to change in tax revenue delta GDP is equal to change in gross domestic product. Change in gross domestic product. Is that okay? Right, just write down there. Here the change in tax, can be due to automatic increase, or due to discretionary changes, or both. Is that okay? Or both, anything can. Okay, continue writing. Change in tax rate may lead to change in tax revenue. change in coverage, change in coverage change in coverage, that is bringing new groups or bringing new group of items, bringing new group of items into the tax base, into the tax base. Okay. These are discretionary changes. These are discretionary changes. Discretionary changes. Okay. 1 second. See, there was even with respect to service tax. Even with respect to service tax, there was this discretionary change that was brought in. For example, just an example. Okay. So, for example, let's say service tax. Okay, service tax. Now you don't have service tax. You have what? GST. Okay. This service tax earlier was brought in through 88th constitutional amendment. Brought in through this. Now it's not there. Service tax has been removed. So initially when they launched service taxes, they said we will levy it on telephone, mobile services, that is telephone services, or general insurance, or something like stockbroking. So we will only levy services on these three. Initially they said when they launched service tax, we are going to levy service tax only on 3 entities. Now this is basically, we call it as a positive list. Positive list. Positive list means you are coming up with list of services on which service tax will become applicable. So whatever I mention, on these mentioned items, there will be service tax that will be applicable. That is called as positive list. Other than those mentioned, service tax will not be applicable. Other than those mentioned, service tax will not be applicable. Is that clear, everybody? Now, after 2011, government said we were coming up with a negative list concept with service tax. Negative list. Okay. Negative list means what? We will only mention those services, only those services on which service tax will not be applied, will not be applicable. Other than those which are mentioned in the list, all other services all other services there will be what? Service tax. This is called as what list mechanism? It is called as negative list. Where the revenues will be more for the government? Negative list. Negative list, suddenly there was a jump with respect to tax revenues. There was a jump with respect to tax revenue because earlier you were just specifying, so those 3 or 5 services or 6 services slowly on which service tax was there. Then after 2011, government said we will come up with negative list with respect to service tax. So it will increase the base, tax base. It is increasing the base with respect to the services which are going to be taxed. No, which one will increase the base? Negative list of service tax will increase the base of service tax. What is the base? A reference with respect to which the tax is calculated. Income tax, the base is income of the individual. Service tax, the base is services rendered. So the base of services rendered is going to increase or widen because of which list? Negative list. So obviously there was a jump with respect to service tax collections because of this concept. Now will this be included in the elasticity? Will this change? No. Will this change? The revenue increase because of this change. It is not automatic. Whether it can be either like increasing the tax rate, It's also a discretionary change, increasing the rate or decreasing the rate like the corporate tax. It's a discretionary change. Similarly, the coverage aspect or GST or coverage aspect, it is not an automatic change. It's a discretionary change. It's a government's decision. It's a discretionary change that government moved from positive list to negative list, which has widened the tax base of service tax. Is that okay? So this is a discretionary change. So this will be included in the buoyancy. Tax buoyancy, it includes this. But tax elasticity should not be including this. Is that okay? Is that clear? These are what? Discretionary changes. Have you understood? Okay, next put the heading tax elasticity. Tax elasticity is equal to, write down, proportionate change with respect to proportionate change. Just write this, I think, 1 second. Proportionate change with respect to, you can write this first. You write this formula, tax elasticity. Delta AT divided by delta GDP. Is that okay? Then write down proportionate change in tax revenue. Write down proportionate change in tax revenue without any proportionate change in tax revenue without any discretionary changes, without any discretionary changes relative to GDP, relative to GDP is called tax elasticity, is called tax elasticity. Okay, continue. That is, it is calculated after, it is calculated after setting aside changes in tax revenue, changes in tax revenue, tax revenue due to discretionary changes, due to discretionary changes. In bracket write adjusted tax revenue, in bracket write adjusted tax revenue. Is that okay? Now, we have time for break. You people are feeling as if like you have listened to already a 2-hour class with great concentration. Okay, let's write one example there. Okay, let's take an example. Write down. Let's take an example. Okay, example, write down. Change in GDP is equal to 10%. Change in GDP is equal to 10%. Okay. Then change in tax revenue, change in tax revenue is equal to 20%. 20%. Okay. In bracket, write automatic change 10%. Automatic change 10%. Discretionary change 10%. Discretionary change 10%. Okay. Then tax buoyancy is equal to, tax buoyancy is equal to 20 divided by 10. Tax buoyancy is equal to 20 divided by 10, that is equal to 2. Is that okay? Tax elasticity is equal to 10 divided by 10. that is equal to 1. I hope it is clear. Understood? Growing tax revenue, growing tax to, same. See here, it is same basically. Tax collections are increasing. Okay. Give me 1 minute. Increasing tax revenues is indicating that the economy is growing. That will not reflect equitable. Not reflect. No change, tax revenue increase will not reflect equitable distribution of wealth. Tax revenue and there's no equitable distribution of wealth concept there. Okay. Proportionate change. It means proportionate change. Okay, so it should be proportionate change, obviously. Okay, so proportionate change. Why? Because already there is some. Okay, it's a proportionate change. So till here it is clear. Okay, so now in the basics class, I have mentioned something like proportional, progressive, regressive, and did we? Okay, methodology of taxing. Okay, very good. This is your first class or second class today? First class only, no? So just like that I've asked. All of you are looking very fresh and so generally you have two, at times you have two classes also? At times, yeah. Okay. Okay. GDP becoming negative. Okay. So GDP turning out negative. Negative is what? Suppose 2018 GDP is 1 lakh total output. 19 GDP turned out to become 90,000. Okay. So my GDP growth here is what? Negative. Okay. Negative. This is what is negative. So when I'm talking about the calculation of value, output. Okay, 2018, when I did Q into P, quantity into price. Okay. So basics only. GDP, we have not discussed national income, basics class. Q into P, I've arrived at a value, 1 lakh rupees. Now in 2019, when I'm doing Q into P, now I've got a value of 90,000. That means my GDP is going negative. Is that clear? Okay. So generally you come across terms like slowdown, etc. I mentioned slowdown. Slowdown is what? Fall in growths. Okay, for example, let's say in 2017, okay, and 2018, when I compare GDP, change in GDP growth rate, earlier GDP was growing at, let's say, 5%. Now GDP is growing at 8. Okay. Let's say in 2019, again, GDP started falling to something like 6%. In 2020, GDP started falling to something like, again, 5%. So, but there is growth. It's not negative. There is growth, but it's not negative. But there is a slowdown with respect to the growth. Slowdown with respect to the growth. But negative means you don't even have 1% growth. This 100 rupees, let's say this 100 in 2017, GDP is 100 rupees. Now this 100 rupees became 95 rupees output. This is negative. Is that clear? Negative. So recession, negative growth rate for more than 2 quarters. You use the word recession. Okay. So methodology of taxing. Okay. So one aspect is based on the concept of equity. Equity concept. When I take equity concept, the methodology of taxing which we use is the progressive taxing mechanism. Based on the concept of equity, government follows something called as the progressive taxing. This is based on the concept of equity. What is equity? Equals will be treated equally, unequals will be treated unequally. As simple as that. It means progressive taxing, if I have to understand. Okay. So if you see, everybody between the incomes of 0 to 3 will be treated equally, but somebody who's getting income between 9 to 12, 15. So this is something like, as my income is increasing, even the tax rate is also increasing. And as my income becomes more than 50 lakhs, you also have something called as the surcharge coming into picture. So this is a clear example, income tax. It's a clear example of a progressive taxing. Okay. But at times they also say income tax can be seen as a digressive tax. So what is the meaning of digressive is? Digressive is something like it is constant for a very long period. Okay, up to a limit it is constant. That is 15% bracket. Up to 15% bracket, no, 30%, 15 lakhs. So up to income being 15 lakhs, it falls under this bracket of what? 30%. But after, if your income is 16 lakhs, 17 lakhs, 18, 19, then also you will fall under 30% bracket. That means the graph is almost progressive. Graph is almost progressive. So it's a progressive example only, no doubt about it. But if I have to extend it, the graph is almost progressive up to my income, up to like 15 lakhs, right? Up to 15 lakhs. But after 15 lakhs, the graph is becoming like this. If I take tax rate here, and if I take income here, let's say this is the 15 lakh, okay, plus income, and this is, let's say, the 30% bracket. 30% bracket. So as my income up to 15 lakhs, you find that progressive trend. Okay, as my income is increasing, tax rate is also increasing up to this point. But beyond this point, the tax is charged at a rate of 30%. Now it is becoming parallel to the x-axis. It's becoming parallel to the x-axis. Now this kind of graph generally you see. So this kind of graph is basically kind of a digressive graph they call. But income tax example can be given for progressive taxes in India, no doubt. Income tax example can be given for progressive taxes because as my income is increasing, tax rates are also increasing. But the observation is, as and when it is moving, till my income crosses 50, till my income crosses, this is 15, no? If my income crosses 50 lakh plus, then again you are liable for what? Surcharge. But of course, this surcharge is not on this income. This is what I was telling. So surcharge is not on the income. Surcharge will be on the tax liability. Surcharge is not on that 50 lakhs. Surcharge is on the tax liability. So therefore, it's a progressive graph only. Is this clear? So what is the need for progressive taxing? Because this is based on equity, reducing the disparity between rich and poor. The logic of, do you think rich people like this taxing? They will always say, the benefit of working hard, government, the benefit of working hard is you are collecting more tax from us. So if we have used our intelligence to work hard, you are unnecessarily collecting more tax. And the rich people's lobby is very strong. Suddenly government comes up with too much of surcharges if they are levied on companies especially. Okay, so they will have huge lobby. They will say, what is this? Poor people, number is more, but their lobbying strength will be less. Rich people, number is less, but lobbying strength is more. So, but in India, when you talk about inclusive growth, so if I have to ensure inclusive growth in countries like India, inclusive growth, I definitely have to go ahead with progressive taxing. Okay, so can capitalism be made inclusive? Okay, so this was a question. It was an essay earlier. Do you think can capitalism be made inclusive? This was an essay in 2015. Do you think capitalism can be made inclusive? Okay, and in the recent mains they said, okay, do you think market economies have to be made inclusive? So in a market economy, one way of making market economies more inclusive is obviously to promote what taxing? progressive taxing. One way of making market economies more inclusive is to go ahead with progressive taxing. Since you cannot replace capitalism today, you cannot replace capitalism. So what is the solution? The solution is benevolent capitalism. Benevolent capitalism is asking them to spend on corporate, that is, you're coming up with social responsibility, spending money on hospitals or all that, environment related programs. And on the other side, you're going ahead and collecting more from the richer classes. I hope it is clear. Okay. So when I take the tax base, okay. So in this tax base for the income tax, the tax base for income tax is what? Income. Income is the base. Okay. So when my income is, let's say 1 lakh, of course there's no tax now, let's say income is 4 lakhs, okay, you are charged at a rate of, let's say, 5%. Okay. But when my income is, let's say, something like 10 lakhs, okay, so you are charged at a rate of, let's say, 10%. Are you able to get this? Okay. So here, as the income is increasing, okay, or as the tax base is increasing here, this is the base. Income is the base. No, don't get confused. Income, for income tax, the base is the income. So as the tax, it is increasing, the tax rate is also increasing. So this is basically called as what taxing? Progressive taxing, which is based on the principle of equity. Equity. Is that okay? Okay. Now, but suppose if, let's say, if I take tax base, okay, and if I am taking tax rate, okay, if say if the tax base is 10,000, the rate is 10%. If it is, okay, so if it is 1 lakh also, okay, if it is 1 lakh also, let's say it is 10%. Irrespective of the base, okay, if there is same amount of tax rate that is levied, irrespective of the base. Your base can be anything. It can be income, it can be profit. Okay, it can be income or it can be profit, anything. So irrespective of the base. So for example, if I am talking about taxes like the corporate tax, which is levied on the profits for the corporate. Okay, so corporate on its profits has to pay corporate tax. So irrespective of the base, okay, you are levying same amount of tax, that is same rate of tax. Of course, revenue collected will be different as your base is widening. Okay, the revenue, that is the tax paid, will be higher. In this case, the tax paid will be higher. The tax paid is 10,000. Here the tax paid is 1,000. Okay, so but the rate is what? Same. So this kind of taxing, we call it as a kind of what taxing? Proportional tax. Okay. So if I have to think of a graph, so generally irrespective of the base, base can be, base can be income or base can be profit, whatever it is. Okay. The rate is going to be constant. The rate is going to be constant. Here I am taking something like the tax rate. Rate is constant irrespective of income or profit. Is this clear, everybody? Okay. Now, then the third one is basically we use a word called regressive taxing mechanism. Okay, regressive. Now, indirect taxes are generally seen to be regressive. Indirect taxes are generally seen to be regressive. Okay, so here, suppose this is the base, okay, and then here if it is, this is the tax rate, okay, 10,000 rupees, let's say you are taxed at 10%, okay, 1 lakh rupees, you are taxed at, let's say, 5%. Is that okay, everybody? Okay. So here, how much is collected? 1,000. Here, how much will be collected? Is that okay? 5,000. But means amount collected may be higher. Amount collected may be higher, but if you observe this, it's a regressive method of taxing. It's a regressive method of taxing. So regressive graph basically, okay, so this is the regressive graph. Is that clear, everybody? Okay, so based on the base, you're calculating, you're levying a higher tax. Is this clear, everybody? Okay, so just so put the heading classification of taxes. Classification of taxes. Or I think it's better. No, change the heading. Okay, you write methods of taxing. Yeah. Okay. Methods, huh? That's better. Yeah, methods of taxing. Okay. Taxing can be based on principle of equity. Principle of equity. Example, progressive taxing. Progressive taxing. Okay, write down, put the heading progressive taxing. If the tax rate increases, with increase in size of tax base, okay. Example, income tax. In income tax, the base is income of the individual. Okay. Progressive taxing helps in ensuring economic equality. Mention new income tax slabs. Please make a note of this. New income tax slabs. This one. Is that okay? Table. Is it visible? Yeah. Just make a note of it. Is that okay? Finished? Done? Only table. Yes. Only table. Don't write anything here. No, don't write that surcharge 5 crore, nothing. Only table, that's it. All that when you write the exam, new budget will come. That time you, this is the other recent budget, no? So not required. So just mention there, here, write down in progressive here, the percentage of tax rate, as well as absolute amount of tax, increases with, as well as absolute amount of tax increase in size of tax base. Increases with increase in size of tax base. Is that okay? Yes. Clear. Okay. If you want to draw a graph, draw a graph. Otherwise, you know that, in the basics class you have done. Next, put the heading proportional tax. Proportional. Write down. Tax is levied as a percentage of tax base. Tax is levied as a percentage of tax base. As a percentage of tax base, irrespective of the size of the tax base, irrespective of the size of the tax base, at a uniform rate, is called proportional tax. At a uniform rate is called proportional tax. Continue writing. Here, the percentage of tax rate remains the same. Here, the percentage of tax rate remains the same, but the absolute amount of tax increases. With increase in the size of tax base. With increase in size of tax base. With increase in size of tax base. Okay. Then put this example there. This one. The rate should be same. Tax base, rate should be same. Is that okay? Yes. Okay, so this is the graph. Okay. Example, corporate tax. When you're on the direct taxes, I will discuss corporate tax in detail. But example, corporate tax. Okay. Then write down regressive tax. Regressive. If tax rate decreases, with increase in tax base, if tax rate decreases with increase in tax base, open the bracket and write income/profit. Close the bracket. Okay, continue. Here the percentage of tax rate decreases. Here the percentage of tax rate decreases. But the absolute amount of tax increases. amount of tax increases absolute amount of tax increases with increase in size of the tax base. With increase in size of the tax base. Is that okay? Then put this. Right. Indirect taxes are seen as regressive in nature. Indirect taxes are seen as regressive in nature. Regressive in nature. As poor people pay, higher proportion of their income, as poor people pay higher proportion of their income, as tax. Okay, done. So in the methods of taxing, okay, there is another method of taxing of goods. So another method of taxing, mainly goods. Okay, so one is you have ad valorem method of taxing. Ad valorem method. And another one is we have something called as specific tax. Ad valorem and specific. Methods of taxing. Another one is ad valorem and specific. Okay. Now, ad valorem method of taxing is basically you're taxing as a percentage of value. As a percentage of value of goods. As a percentage of value of goods. For example, if excise duty is 10%, okay, that means 10% on a car which is costing 4 lakhs. So it can be around 40,000. Okay. Similarly, 10% on a value of car, which is, it can be 5 lakhs. Okay, then the tax collected is how much? 50,000. So here what is happening? Ad valorem is you're taxing on the value of goods. So this ad valorem tax collections can increase when the price of the good is also going to increase. Price of the good is increasing, the tax collected will also increase. Okay, this is one way of taxing. Now, another way of taxing is, suppose if there is a fixed amount of tax on the quantity of goods produced. Fixed amount of tax on quantity of goods produced. It can be quantity, it can be size, or maybe shape, whatever it is. Fixed amount of tax. For example, suppose you're saying the tax is 100 rupees on, let's say, 5 kg of iron or 5 kilos of iron, okay, produced. The tax is 100. Now, if the tax collections have to increase, then the number of goods produced, or the output basically, production, in this case, production should increase. So this is not based on value. It is based on, other than value, it can be quantity, it can be size or shape. For example, if cigarettes in India are taxed based on the length of the cigarette. Okay. So if that means the lengthier the cigarette, then if you are levying a higher duty, higher tax. This is basically a kind of a specific tax. It's a kind of a specific tax. For example, even cars. Okay, so when we talk about cars in India, suppose you're saying SUVs, the lengthier the car, okay, the lengthier the car, okay, it crosses a limit, okay, so there is an additional tax which you are paying. Now this is a kind of what? A specific tax. So both the taxes can be levied, both methods can be used. For example, if you say the tax is something like 10% on value of the car plus an additional 50,000 rupees, just an example, additional 50,000 rupees if the length of the car crosses a particular limit. So that means you can levy both ad valorem as well as specific together, ad valorem and specific taxes together. If you want, both can be levied. Okay, so generally compact SUVs, when somebody is coming and selling compact SUVs, too much of compact, like Ford EcoSport or something. So first of all, it is not an SUV, pure SUV, but he says it's a compact SUV. Okay, and in some of the states, even IPS officers were given Ford EcoSport, states without revenues. So they were giving Ford EcoSport, and some of the students were also frustrated. Okay, so they started improvising the bumper. They started extending the bumpers. It should look like an IPS car. So, so all this. Now, they said, how will a Ford EcoSport fellow come and tell, this is a compact SUV. The amount of tax that will be levied also will be less. So, do not worry. Okay, so that's how he tries to sell a compact SUV. That means length also can. So, this is basically specific. So, specific tax collections will improve when production increases generally. Production, quantity produced increases. Okay, so write down. In the methods of taxing, yes. Goods can also be taxed based on ad valorem, ADVALOREM, ad valorem, or specific tax, ad valorem or specific tax. Okay, then put a side heading, ad valorem tax, ADVA, ad valorem tax, write down. If tax is levied as a percentage of, value of goods, regardless of number of units produced, slash sold slash produced slash sold slash imported. Is that okay? Example, 10% on the value of car, 10% on value of car, excise duty, anything, 10% on value of car. Revenues will increase with increase in price. Write down. Revenues will increase, tax revenues will increase with increase in price. Example, if the price of a car is 2 lakhs, the tax amount is 20,000. And if the car prices increase to 4 lakhs, the tax amount collected is 40,000. The tax amount collected is 40,000. Is that okay? Next. Put the heading specific tax. Specific, write down. If tax is levied at a flat rate, if tax is levied at a flat rate, tax is levied at a flat rate per unit of goods produced, per unit of goods produced slash sold slash imported. Imported. Regardless of value, regardless of the value, regardless of the value, then it is termed, or then it is called, then it is called specific duty. Then it is called specific duty. Then it is called specific duty. Is that okay? Example, rupees 2 per 1 kg of iron. Rupees 2, 2 rupees per 1 kg of iron, comma, rupees 3 per 1 meter of cloth. Rupees 3 per 1 meter of cloth. Okay, write down. Here the revenue increases. Revenue increases only with number of units. Only with number of units. Only with number of units and not value. Number of units and not value. Continue. In the above example, if the car price increases from 2 lakhs to 4 lakhs, in the above example, if the car price increases from 2 lakhs to 4 lakhs, and the government collects a tax of rupees 10,000 per car, and the government collects a tax of rupees 10,000 per car, 10,000 per car. The tax revenue will only increase. The tax revenue will only increase if the sales of the car increases. If the sales of the car increase. If the sales of the car increase. Is that okay? Yes. Continue. In some cases, both type of taxing can be levied. Both types of taxes can be levied. Both type of taxes can be levied on the same good. On the same good. Example, rupees 10,000 per car. Rupees 10,000 per car. Plus 10% on the value of car. Plus 10% on the value of the car. In this case, it's one size, one other example. It can be quantity, it can be size as well. Now, classification of taxes, we have classified it. The basics class, you know, one is the direct tax, another one is indirect taxes. Remember this? Okay. And from the basics class, one thing should be clear, that when I say indirect tax, we have written impact and incidence of tax are at different points. Impact and incidence of tax are at different points. Okay. So here impact and incidence of the tax are at same point. Same point. Is that okay? This is something which we know. Impact and incidence at the same point, impact and incidence at different points. Okay. In a welfare state where you are aiming for inclusiveness, okay, indirect tax rates should not be high. Indirect tax rates should not be high because the poor man and the rich man pay the same amount of tax, but the poor man ends up paying higher proportion of his income as tax. Therefore, indirect taxes, you cannot keep rates at a higher level. This is not correct. This is not correct. Very high tax rates is not good because it will affect the welfare or inclusiveness, because indirect taxes are seen to be regressive. And most of the time, these indirect taxes only, you also have the challenge of cascading effect. You have the challenges of cascading effect in these indirect taxes, and that was making the product costly for the common man. You know the mobile example. The same thing applies even with respect to production process. The same thing applies for the production process. We'll try to understand it through an example. Okay, so for example, one indirect tax is excise duty, and we all know that excise is levied on production. In general, excise should be part of list 1 or list 2. List 1, except for excise on alcohol, but otherwise excise clearly is mentioned. Now of course excise is deleted in the list 1. Only it is clearly, now in the list 1 if you open, you will find excise on 5 petroleum products. Now it is mentioned excise on 5, they will not mention excise duty as such, because the word excise duty has been removed from the list 1, because you have rationalized it through the concept of GST. But what will be mentioned? Mentioned would be excise on 5 petroleum products is levied by center. This will be mentioned. Excise on 5 petroleum products is levied by whom? Center. This should be mentioned in the list, union list. Otherwise, center will not have powers to levy excise duty on the 5 petroleum products, because today petrol is not included in GST. Petrol is not included in GST, and therefore center has the powers. So in the constitution, it should be clearly visible that on 5 petroleum products, excise duty will be levied by center. This should be added. Though you remove excise duty, this should be added. Only then center can levy excise duty on petrol. Okay, so that will be mentioned. Now earlier, when it comes to excise duty, government has observed that because of cascading effect, this indirect tax called excise, there is a challenge. And there were several cases filed in the Bombay High Court with respect to excise duty. One simple example, suppose Ratan Tata is manufacturing some car, Nano, or some car basically. Now Ratan Tata, let's say he decided to buy steel from Adani Group, or he decided to buy rubber from MRF for tires. Tires is buying, let's say tires is straight away buying from MRF, or for the interiors is buying plastics from a company called Adunik Metallics. Many companies are there, Adunik Metallics, which is buying something like the plastic and interiors and all. Okay, let's say with respect to manufacturing of steel, Adani has already paid something like excise on steel. Excise is already paid on steel. Excise duty is paid on steel. So in indirect taxes, he will not bear it. He will push it on Ratan Tata. He will push it on Ratan Tata. That means if Adani has paid excise on steel, Okay, that cost will also included in the steel, and that will be pushed to Ratan Tata. Okay, let's say it is something like 10,000 rupees is the excise which is pushed into the price of the steel, and you have sold it to Ratan Tata. Same applies with tires of MRF. Tires of MRF, let's say 5,000 rupees is the tax on excise. Excise is always on production. So on the production there is this tax that is paid, which is also included in the cost, and it is sold to Ratan Tata. Same with respect to plastics, Adhunik Metallics, another 3,000 rupees and sold to Ratan Tata. Now Ratan Tata is again manufacturing this car. On the manufacture of this car, he is manufacturing, it's a new manufacture of this car. Again Ratan Tata has to pay excise on car. Excise on this car manufacturing, Ratan Tata is paying. Okay, but the challenge comes up for Ratan Tata that Ratan Tata has already paid excise on tires to MRF included. He has already paid excise on steel, which is already included. Okay, and he's also paid excise on plastics, which is already included. Now on the whole car, again, when he's paying excise, you are including this and paying. That means Ratan Tata is landing up paying tax twice on tires. He's paying tax twice on steel. He's paying tax twice on plastic. This is tax on tax with respect to an aspect called as excise. Tax on tax with respect to excise. It's not that Ratan Tata will bear it. Ultimately, Ratan Tata will push it to the final consumer. Ultimately, Ratan Tata will not bear it. He will push it to the final consumer, and the car will become costly to the final consumer because of this challenge of cascading effect related to excise. Are you able to get this? You landed up paying tax twice. Now this challenge, they thought this is excise duty, there is a cascading effect with respect to excise duty. And this cascading effect has to be handled. And government decided to come up with a concept of manufacturing VAT. Government decided to come up with a concept of VAT, manufacturing VAT. So they wanted to bring in a concept of value addition with respect to excise. What was the purpose of bringing in VAT? Is mainly to reduce the cascading effect with respect to the excise duty. Okay. So we'll look into it with an example. This manufacturing VAT got later, they converted it into mod VAT, modified value added tax. So this mod VAT in 1980s basically, this mod VAT is related to which duty? Excise, manufacturing VAT on manufacturing only, and value added concept. That means you're bringing a concept of value addition into manufacturing, that's all, value addition, and that VAT got converted into modified value added tax. Then subsequently this mod VAT again got converted into central value added tax later. Okay, central value added tax. Now this CEN-VAT is also not there. Now this is also included into the system, that is the CGST system, Central Goods and Services Tax. So you don't have CEN-VAT also now. Okay, so why did they come up with this concept? Let's try to understand. So why did they bring in a VAT concept or a value addition concept with respect to manufacturing? The main purpose is to remove this cascading effect. It's leading to cascading effect, car is becoming costly. Now the concept of value addition basically runs like this. Okay, let's say there is one furniture manufacturer, just an example. Let's say this furniture manufacturer or let's say there is a wood manufacturer, and this wood manufacturer has sold this wood to the furniture manufacturer. Just take it that way. So in this case, 40,000 rupees worth wood, which is the input for, this is input for this furniture manufacturer. This is an input for this furniture manufacturer, and this furniture manufacturer was able to convert this 40,000 worth wood into something like 4 lakhs worth furniture. Okay. 4 lakhs. Furniture manufacturer was able to convert wood worth 40,000 into 4 lakhs. Okay. That means this furniture manufacturer was able to add a value. What is the value addition done by the furniture manufacturer? Around 3,60,000. Around 3,60,000. Is that okay? Now, on this input, let's say 10% duty is already paid on this input. 10% is the duty or tax, excise duty. Okay, so 10% means around 4,000 rupees is already paid on the inputs. Okay, on the output is 4 lakh. On the output, there is a tax, excise tax of 10%. Now, so 10% is how much? Around 40,000. Around 40,000. 10% of 4 lakhs. Now, the logic of value addition works like this. Whatever tax you have paid on inputs will be refunded back to you when you are filing your taxes on output. Okay, when you are filing your tax on output, the tax which you already filed on, or tax which you already paid on inputs will be refunded back to you, okay, at a later date when you are trying to settle this. So, you will pay 40,000, but later this 4,000 will be refunded back to you. This 4,000 rupees will be refunded back to you as input tax credit. Will be refunded back to you as what? As what? Input tax credit. That means on the input you have paid some tax. This will be refunded back to you on your outputs as input tax credit. Input tax credit. Okay. So, when Ratan Tata or somebody, this furniture manufacturer, when he is filing his taxes, he has to show this receipt of 4,000 rupees which was paid on inputs. This is an input, no? This is a raw material which on input. You have to show this tax receipt. Later, Ratan Tata or somebody who is this furniture manufacturer will be able to get this 4,000 as input tax credit. Now, once he gets this 4,000 as input tax credit, now what is the tax liability of this manufacturer? Tax liability will be 40,000 minus 4,000. It becomes how much? 36,000. Okay. What is 10% of 3,60,000? What is 10% of 3,60,000? 10% of 3,60,000 is also what? 36,000. That means because of this concept of value addition, ultimately the tax was only levied on the value addition. If I have to take tax only on the value addition on 3,60,000, okay, that means you are only taxing the value addition, then you end up paying how much? 36,000. So, this 36,000 is also 10% of 3,60,000, indicating that you ultimately landed up paying taxes only on the value addition. Are you able to get this? Now, VAT reforms. I am not talking about VAT or the sales tax concept. This is not, I am not talking about the sales tax. So, sales tax at the state level was replaced by a concept of VAT system in 2005. Okay. So, that is sales. Now, you do not have this. Today, you do not have this. Everything is part of your GST. This has gone into SGST. Okay. Now, what you should understand is the benefit of value addition is this input has not been taxed twice. As simple as that. This input has not been taxed twice because this has been refunded back to you as input tax credit or ITC. This concept of ITC. So, what did we do? This is nothing but VAT on output. So, the tax liability will be VAT on output minus VAT on input. VAT on output minus VAT on input. So, here it becomes 40,000 minus 4,000, that is again 36,000. So, this 36,000 is nothing but 10% of 3,60,000. That means ultimately you landed up paying tax on the value addition. So, this concept of value addition basically, is that okay? This concept of value addition basically will reduce the cascading effect with respect to what? Excise. So, they wanted to bring a concept of value addition into manufacturing in the format of manufacturing VAT. Manufacturing VAT. So bringing a concept of VAT system into the excise duty. Excise is on manufacturing, so that you reduce or you remove the cascading effect. Is that clear? Okay. Then they modified this into modified VAT. There is a committee called LKJA committee recommendations through which they have come up with mod VAT. Don't worry about that. We'll write it in the notes. You just understand. So mod VAT. But this was a period when service tax was not included. This was the period when service tax is still not included. There is no 88th constitutional amendment. Now suppose there is an engineer who is running a consultant firm. Suppose there is an engineer who is running and is an engineering consultant, automobile consultant. Okay. Now this extraordinary design of nano was given by this consultant. That is, you should have the engine, okay, the car style and all, he draws everything, the consultant comes up with. Now, what did this consultant do? This consultant has rendered a service. The consultant has rendered a service. So, when you are rendering the service as a service provider, for example, our institute is rendering a service, education service. As a service provider, so the organization also has to pay some service tax or it has to pay GST to the government, But ultimately that GST has to be collected from the customers, end consumer. Same logic. This is indirect tax, no? Indirect tax. So the organization is only an intermediary between the final consumer and the government. Same logic. Okay. Now here the service consultant has to pay something like the service tax. As a renderer of service, he has to pay service tax obviously to the government. Okay. But again this service tax will be collected from the final consumer. Here the consumer is Ratan Tata. That means again it will be consumed or it will be collected from Ratan Tata. So when Ratan Tata has to make this payment, Ratan Tata will also include it in the cost of the car. Ratan Tata will include it in the cost of the car. And on this again, on the price of the car again, you're calculating the excise duty. Are you able to get this on the price of the car? But whatever Ratan Tata has paid as inputs, tax on inputs, for example, plastic, this 3,000, Ratan Tata is refunded back. Because this is manufacturing inputs, this is also manufacturing. So excise, this is excise, this is excise. Or excise on excise, on VAT on output minus VAT on input. This 3,000 is given to Ratan Tata as input tax credit. Okay. This 5,000 is also given to Ratan Tata as input tax credit. Now this 10,000 is also given to Ratan Tata as ITC, input tax credit. The same concept which we discussed on the furniture. So input tax credit or whatever taxes you paid on inputs are refunded back to Ratan Tata as ITC. So cascading effect with respect to these inputs like plastics or steel or tires has been removed. But under the mod VAT concept, under the mod VAT, modified VAT concept. On manufacturing, all these are manufacturing. So on manufacturing, VAT related ITC, since ITC is given input tax credit, so the cascading effect on these inputs is removed. Is that okay? But suddenly service tax started coming in, but now the service tax being refunded on manufacturing was an issue. Service tax being refunded on manufacturing. This is manufacturing, now this is service tax. So they were talking about giving service tax as ITC on manufacturing, service tax as input tax credit on manufacturing. So that was a challenge with respect to mod VAT. So then they designed CENVAT, Central Value Added Tax, which said it will include even the services as well as goods. It will include, CENVAT will include both services as well as goods. So whatever you have spent on services as well as goods will be refunded back to you as ITC, input tax credit, and that's how this concept of central value added tax has come up. Okay, and now this CENVAT is also not there. CENVAT is also subsumed into CGST, Central Goods and Service Tax. Is that clear, everybody? No. In CGST you have all other taxes, no? It's not just SENVAT in CGST. Okay, so SENVAT is one of the tax which is subsumed into GST. So I can't say SENVAT is same as CGST. Okay, so SENVAT is one of the taxes related to excise which got subsumed into CGST. Service tax is one of the taxes which got subsumed into CGST now. Is that okay, everybody? And those goods which are outside the GST system, even today, the old procedure follows. What is the old procedure? Excise will be levied by center and sales tax will be levied by the state. One such example is petrol. Since they could not come to a consensus as to put how to share petrol, so even now petrol excise by the center, sales of petrol, sales tax on petrol will be levied by the state. Both together is creating a problem for the consumer. Are you able to get this? No, both together, both center excise, state excise, both. It's going, in some states it has gone to 30% plus. 30% plus is more than the luxury item under GST. The luxury item under GST is 28. Petrol is not a luxury. Petrol is not a luxury. Of course, I'll not say it's a necessity. So I'll take it this way. I'll say it's not a necessity, but definitely it is not a luxury. And common man is also using, especially diesel. When I talk about diesel pumps, diesel is used by the farmers. Diesel has a direct impact on food inflation. Transportation cost is going to increase. So directly impacts food inflation. So the logic of removing subsidy with respect to petrol and diesel, though it can be seen as okay. Why? Because government was overspending money on subsidies on petrol and diesel. And diesel cars are a luxury, polluting the environment, especially SUVs and all. So subsidizing Shah Rukh Khan and Virat Kohli is wrong. Subsidizing rich is a crime. And therefore, government removing subsidy on petrol, on diesel and petrol is okay. But government continuing with higher tax rates, like excise, very high rates, is it okay? Definitely not okay. Definitely not okay, including the state governments. There should be some rational procedures where the taxes on petrol and diesel will be maintained. Some solution, intermediary solution has to be brought in. No? A middle path, you call it as a middle path has to be brought in. Otherwise, it's not correct. I think you're getting my point, right? It's not correct because some states are 38%, it has gone, in some states 42%. Okay, in 2000, in the recent past when government was questioned, government was also giving some statement saying that we were already paying the bills of previous governments, oil bonds and all. And that also is not true because that has already ended. If you see the numbers, basically, that has already ended by 2019-20. Okay, so somehow government should look at other ways of increasing tax revenue rather than depending on petrol and diesel. That is the way out. Is this clear, everybody? Okay. What? Don't ask true or not. You come after the class. I'll explain. Okay. So about the government, you come after the class. But one thing is for sure that there should be some rational procedure with respect to this. Excess on alcohol, leave it. Alcohol is an item outside GST. Okay. So state. Alcohol is state. You see those states which have banned alcohol have lost their revenues. So see the excitement. Okay, so they have lost their revenues. You know, the revenues have come down for those states. Some states which have banned. Tourism has gone down. Tourism, generally when you go to Goa, so you start packing all the bottles in the car. Okay, and you are very eager. And somebody catches also, you use all the nonsense, you say, no, I'm an army man or something, or you say, I'm from police department, without any ID proof. Okay, why are you doing that? In fact, because the taxes are very limited in some states, and taxes are high in some states. Yes or no? Haryana, yes. Okay, so there's a lot of knowledge here. You can't pick up bottles from Haryana and go to Hyderabad also. Okay, so nowadays even a single bottle is checked because taxes are different. This you have a lot of knowledge, very good. Okay, but excise on alcohol, state, not included. Alcohol is excluded from GST, and who is handling it? From the beginning also. Excise on alcohol was in list 1 or list 2? List 2. Excise on alcohol, list 2. Okay, so. Yes. Yes. Yes, you have to. So any manufacturing. Is that okay? Why? Restaurant in? Are there on alcohol? That is what you are asking. Bar charges on alcohol. VAT? Okay. VAT on alcohol. Okay. Why is it there? What is VAT there? That VAT is basically sales tax. That VAT which you are talking about is sales tax. So sales tax anyhow state will, since alcohol is outside the GST system, okay. So sales tax has to be levied by whom? State. State. Yes, that's the reason you have VAT on alcohol. This is why it is different. This is mod VAT is value addition concept with respect to excise duty. I am talking about central government's VAT. Central. Sen VAT means what? Central government's VAT. Central value added tax. So here we are referring to central government's VAT. Same applies. See, alcohol is outside GST means sales tax on alcohol will be levied by whom? State. So that is state VAT. Okay, so. Arey yaar, I wanted to dictate. Okay, yes. No, why can't government store? Hey, wait. Please, yes. See, in India, first of all, identifying BPL is an issue. Okay, you are talking about separate stores for BPL. Who will open stores? Government. See, actually, if you know, listen, so his logic is, he has a very ethical logic, but it will not work. It is an emotional concept. Now listen. So if you know that tax slabs are there, now here, listen. To reduce cascading effect and all, so though you had VAT concept, since cascading effect could not be removed completely, we came up with this concept called GST. That means if the earlier systems would have been very efficient, then there is no discussion of GST. So you have brought in GST means there were some problems in the previous systems. Okay, that means completely cascading effect could not be removed in the VAT system, and therefore you have the concept of what? GST. And there also you said we will come up with 0. Different tax slabs are there, 12, 18 and 28. Okay, let's say these are the slabs. What do you think is the reason for this slab? That I know. Like why? This is an artificial mechanism to make indirect tax like GST progressive. Artificially. This is also called as tax democracy. So the poor man, let him pay lesser tax. The rich man, let him pay more tax. Indirectly, this is an indirect tax. No, indirect taxes are not progressive. So artificially, I want to make indirect taxes progressive by coming up with different slabs. So Arun Jaitley, when he was thinking about this model earlier, he was questioned this number of tax slabs which you are talking about will reduce tax efficiency. Will reduce tax what? Efficiency. In fact, more the slabs, more is the inefficiency. So then economists who are doing this research, one suggestion they said, why don't you come up with single one nation, one tax, one rate? This is one nation, one tax, but multiple rates, 0, 5, 12, 18, 28. Now, when you are trying to come up with the logic of GST, why can't you think of one nation, one tax, one rate? So, tax at 12%. BPL families, give it in the form of tax credit. Identify BPL families if they have bank accounts like the LPG credit. As when you spend money on the gas cylinders, you know that subsidy was given. It was coming into the bank accounts. Okay. So, in the same manner, why don't you refund it back to the BPL families? Now, identify BPL families. Anyhow, you have linked up Aadhaar and BPL. So, you will be able to identify easily, and why don't you give the extra amount which they are paying in the form of tax credit or subsidy? Okay, innovative idea. It will reduce the inefficiency because one slab, no tension. Suppose I am manufacturing glass bottles, and I am selling these glass bottles for Kingfisher beer. Now I will show it as selling this glass manufacturing is mainly for midday meal scheme for kids. Okay, and I will put it in 0% or 5% bracket. There is more scope for manipulation when the slabs are higher. More scope is there to manipulate. I can manipulate things out when the slabs are high. But therefore, there were suggestions given by economists. So, if you want to really take care of poor, as you was talking of poor, why don't you come up with a separate shop and all, and where you have less taxes. Okay, here the suggestion is come up with one slab and refund it back. No, so your efficiency, tax efficiency will be higher. Then Arun Jaitley's answer was, it is not just that you come up with a policy. Justice is done, but justice should be seen to be done. Okay, here justice is done, but at the same time, another aspect is people should know that we are able to put necessities into a box 0%, and we are taking care of poor. And we have made it artificially progressive, and GST is a very good reform. It will bring trust in the public mind, because richer people, we are putting it in 28%, and poor people, etc. So sometimes generally they keep it hopping also, no? 5% they push some into 0, and from 5 then 0 to 5. They can do that before elections and all. But ultimately, this is what is tax democracy. Okay. So few things may be efficient, but in conditions like India, you can't follow. Today, if you know, the efficiency of GST has come down. Today, efficiency of GST, of course, government reports say GST revenues are coming up, but already our traders are so intelligent that they have already identified the loopholes in the system. Very intelligent. They always follow a policy, you win, I win, we win. Okay, so, and that's how now GST also, slowly the mechanism started becoming, don't pack your bags. Okay, wait. Okay, fine. Is it clear till here? Okay, we'll write it tomorrow. Thank you.